Friday, July 2nd, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at the pointlessness of holding bullion. Is that what I think? Of course not. It's what the FT thinks. It's what they wrote in their editorial page back in 2004. I found it so outrageous that I cut it out and laminated and kept it for posterity. I was waiting for my train to go to work and I was reading the FT. Usually turned it to the editorial section. I used to like doing that, and I saw this going gold. There you go. And they say here the pointlessness of holding bullion continues to sink in. Yes, many of you have heard this story before, but I think it's very applicable to what happened to a friend of mine recently, and a very good friend of mine, the individual that I worked with when I came to the city of London back in 1992. We still keep in touch, and it's to do with his mother, and I'll come to the story in a minute. I just like to say a few things first. I'd like to thank all the viewers, subscribers, supporters of the channel, people who have been going on Teespring store, people who support me on Patreon. How does the Patreon support work? Well, for a minimum of $1 a month, you can ask me questions directly there, even though, of course, I try to answer questions in the comment section. You might have more private questions you want to ask, so you'll be able to get a hold of me through there. I don't do any special videos on Patreon just for members. I like to do all my videos for everyone, really, so that's how it works. I'd like to thank all the people who donate through PayPal as well. So yeah, the other day, or actually a few weeks ago, this friend of mine contacted me. He said, my mother has these sovereign coins. She was given like 50 years ago, probably from family, right? And my friend has British passport, but they're originally from Kuwait. And back when Saddam Hussein invaded Kuwait, his family left Kuwait. I think they had to flee Kuwait. So they came to live in London. And so I assume his mother took those gold sovereigns with her. I don't know what the situation was when they left Kuwait. They must have been in a rush. So she was able to probably easily take those coins with her. She's had it for 50 years. So he called me a few weeks ago and said, my mom wants to sell a few of her coins because she's in her mid to late 80s. She's had it for 50 years. She wants to enjoy those coins. She doesn't need them anymore. And it's not because she thinks gold is going to go down. She doesn't care because she looks at it as something to store wealth. And that's the right thing to do, of course. And yesterday then my friend went with his mother to see gold investments, to see Simon. Oliver wasn't there. And so I got a call from my friend yesterday. It went very smoothly. They got what they wanted. And Simon said it's a shame that you have to part with these coins because I think they were George V sovereigns, pretty old coins, but they still worked. She didn't have to update them every 6 months with new software or anything. She just held it like jewelry, I guess. And I've done a calculation of roughly where gold was in British pounds back on the 1st of July, 1971, which is 50 years. She might have gotten this before 50 years. My friend might be wrong about how long she's had it. She might even have had it for longer than that, but I took 50 years because that's what he told me. So I've taken some data from the LBMA. I know about the LBMA and COMEX and the unallocated market, but they keep good data. going back to 1968. So I took the price of gold in sterling or British pounds on the 1st of July, which was yesterday, which was the day that my friend went with his mother to sell the sovereigns. And it was at 16.576 per ounce. So in terms of sovereign, it was worth £3.90, £3.90. So my friend sold it for around 303 pounds for his mother. So yes, 3.9 pounds per sovereign. Yeah, that seems quite amazing, doesn't it? Over 50 years. So I've calculated here, I've used this Omni calculator, basic return on investment. So I put 3.9 pounds, returned amount 304, and then I put time difference 50 years. So the annualized return on investment was 9.1%. So I wanted to look at how this return on the bullion coins had been or has been compared to inflation. So I went to the Bank of England website, to their inflation calculator. I typed in 1971 and 2020. And according to the Bank of England, inflation has been averaging 5.6% per annum since 1971. So my friend's mother got a return of 9.1. So it comfortably beat inflation over that period by about 3.5%. So has it really been pointless for this lady to hold on to these coins for so long? I don't think so. And I don't even think she needed to sell them, but she thought I might as well sell it now and spend it, enjoy myself, do something for her grandchildren or whatever she wants to do. And so, yes, FT, that was quite pointless, wasn't it? So I was so outraged by this editorial that I even wrote the date that I read it. So it was April 16th, 2004. And the price of gold at the time was $400.65. Why 65 cents? Well, that's when I looked at the price there, that's where it was, and that I wrote the price. So it wasn't 400, it wasn't 401, it was 400.65. So I'll quickly go through this editorial so you can see what the FT wrote back then, and why you shouldn't really trust mainstream media or mainstream business channels like CNN or CNBC or Fox Business or any other one. So the pointlessness of holding bullion continues to sink in. So yeah, it's going gold. The barbarous relic, as Keynes called it, is crumbling to dust. When even the venerable N.M. Rothschild has quit the gold market, and the Bank of France, among the most stubborn of the official gold bugs, is thinking again about its bullion holdings, the end of gold as an investment has come a little closer. Yeah, I noticed Michael Saylor the other day said that gold is finished. It's finished in the 21st century. I guess he hasn't been following gold for that long. It will not be before time. The fetishization of shiny yellow metal, decades after it ceased to be used as an anchor of the international monetary system, is a lingering anomaly in modern financial markets. Perhaps Rothschild's last service to the bullion market could be to keep a live gold trader on display behind glass as a reminder of a bygone age, like the former coal miners who now make a living giving tours of defunct pits. The one advantage of gold as a reserve asset is that, unlike assets based on fiat money, Governments cannot make it worthless by inflating it away. Well, that's right. That's right, FT. But in an era of low inflation, and given that independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. Wow, how wrong were they, right? With what the central bankers are doing now. Indeed, for both private and official investors, gold is now a rather risky asset. Well, tell that to my friend's mother. She doesn't think it was risky. It's done the job for her over her lifetime. With a nil or low return, well, 9.1% over 50 years annualized. I think that's pretty good return. The intrinsic value of gold, determined by its use in various industrial processes, is well below its market price. Gold does not grow, so its value to any one investor as an asset is dependent on other investors also holding it as an investment asset. The gold price hangs precariously by its own bootstraps. So... yeah, you can imagine me reading this at 6 o'clock in the morning. That's how early I used to go to work. I used to walk from home to the station, and I used to get there always a little earlier to buy my paper, start reading it. I always like to be punctual. So my train arrived at around 6:08. So yeah, this was early, and I was reading this. I was like, whoa. For private investors to hold gold on this basis is their own foolish affair. For central banks and governments to hold it as a reserve asset is a betrayal of the public on whose behalf they are acting. Despite recent sell-offs, governments and central banks still hold about a fifth of the world's bullion. I think it's about 17% right now. Their large holdings relative to the size of the market by themselves make gold particularly ineffective as a reserve asset. The very act of official selling of bullion on any large scale to raise cash will itself drive down the price. The danger was amply demonstrated by the UK's unhappy experience of trying to sell some of its gold holdings. Announced in 1999 in a sensibly open and transparent fashion, the sale sparked such a fall in the global bullion price that a group of central banks signed a concord limiting such sales. That has recently been superseded by a new agreement providing for limited official sales. While the story about Gordon Brown that the FT doesn't tell you is that there were bullion banks in the city of London who were in trouble because the price of gold in 1999 started going up from like 250 to 300, and they got caught short and they were losing a lot of money. So he actually pre-announced the sale. So what did you expect by pre-announcing the sale of gold, by not doing it on the quiet and then telling the world, yeah, we sold our reserves? It probably wouldn't have affected the price, but they did it on purpose to try to bring the price down to help the bullion banks. Rumor is that it was Goldman Sachs. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters, unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price. That would imply some irrationality on the part of the market. But then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Doesn't make sense, right? It's irrational to hold gold, but for some reason the FT still thinks maybe the central bank should hold it. Whatever the speed, the direction is clear. Gold is on its way out as an investment and a reserve asset. 3 cheers for that. So let's look at where the markets are this morning then. It's 8:45 a.m. London time. Today, the big event for the markets will be non-farm payroll data, US job data. That's still heavily followed. It still affects the market in the short term. It could create a lot of volatility. I actually spoke to my friend yesterday. He's still in the city. And he said, yeah, volatility has been crushed, according to him. I don't follow it very closely. So we could see something quite interesting this afternoon. Non-farm payroll data come out at 8:30 a.m. Eastern time, or 1:30 p.m. London time. So right now we got spot gold at 1777, pretty much unchanged. We're still trading within a narrow range for almost 2 weeks. So range has been 1780 to 1774. Spot silver is at 2604, up a cent. High's been 2610, low 2597. The Dow futures up 30, NASDAQ futures up 20, the S&P futures up just under 4 points. Sterling is down slightly at 137.53. I think sterling got hit relatively hard yesterday. I don't know what that was about, but the technical picture doesn't look very good for the pound versus the dollar. The euro is down 0.2% at 118.25. The dollar is relatively firm versus the yen. We are now at 111.58, up slightly on the day though. The dollar is fairly strong against the yuan, up 0.25% at 648.78. Aussie dollar is down quite a bit here. We're down over 50 pips overnight. We were above 75 yesterday. Right now we're at 74.55. My system is saying down 0.2%, but that's because they look at a different time frame. So yeah, Aussie dollar coming a little bit under pressure. WTI crude down slightly at 74.76. So yeah, crude continuing to rise. The trend looks pretty positive in crude. High-grade copper is up 0.5% at 425.70, and the 10-year yield is at 146, down just over 2 basis points. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.